If you're buying a house, you might think a loan officer or an underwriter decides whether you're approved for a mortgage. But that's not actually how it works. Most mortgage approvals in the United States are decided by automatic underwriting systems run by two massive housing institutions, Fannie Mae and Freddie Mac. And those systems are called DU and LP. In this video, I'm going to break down what Fannie Mae and Freddie Mac actually are, what DU and LP stand for, how the systems analyze your loan application, what factors actually determine your approval, and what most buyers do wrong that causes their loan to get denied. By the end of this video, you'll understand exactly how mortgage approvals really work behind the scenes. Before we talk about approvals, we need to understand who actually makes the rules. Most mortgages in the U.S. follow guidelines set by two government-sponsored enterprises, Fannie Mae and Freddie Mac. These organizations don't lend money directly to consumers. Instead, they buy loans from lenders after closing. That process is called the secondary mortgage market. Here's why this matters. When lenders sell loans to Fannie or Freddie, they get their money back and can make more loans. This creates liquidity in the housing market and keeps mortgage rates lower than they otherwise would be. Because of that, lenders must follow Fannie and Freddie's rules when approving loans. And those rules are enforced through automated underwriting systems. Each agency has its own automated system. Fannie Mae uses Desktop Underwriter, also known as DU. Freddie Mac uses Loan Product Advisor, also known as LP. These systems analyze a borrower's entire financial profile in seconds. Instead of a human manually calculating risk, the system uses algorithms and historical mortgage data from millions of loans. When a loan officer submits a file into DU or LP, the system evaluates the loan and returns a result. That result determines whether the loan is eligible for approval. When a loan is run through DU or LP, the system reviews a complete borrower profile. This includes a credit score, credit history, income, employment, debt obligations, assets, down payment, property type, loan-to-value ratio, occupancy type. The system then compares that data against millions of historical loan outcomes. It's essentially asking the question, based on past performances, how likely is this borrower to repay the loan? After the system analyzes the file, it produces a finding. The most common findings are approve eligible. This means the loan meets the guidelines and can move forward. Refer eligible. This means the system cannot approve the loan automatically and it must be manually underwritten. Refer with caution. This usually means the risk is too high and the loan will likely be denied. Ineligible. This means the loan doesn't meet agency guidelines at all. Most lenders aim for approve eligible because those loans qualified for automated underwriting approval, which reduced risk for the lender. Although the system reviews dozens of variables, there are three or four major factors that drive approval. Credit score. Credit score is one of the biggest indicators of repayment risk. Higher scores generally mean lower default risk, better approval odds, and better pricing. Lower scores may still be approved, but the system will often require stronger compensating factors. Debt-to-income ratio. Debt-to-income ratio measures how much of your income is already committed to debt payments. This includes mortgage payment, credit cards, car loans, student loans, and personal loans. Most conventional loans aim to stay under about 45 to 50% debt to income, although approvals can vary depending on the rest of the file. Loan-to-value ratio. Loan-to-value represents how much you are borrowing compared to the value of the home. For example, if you buy a $500,000 home and put 5% down, the loan-to-value is 95%. Higher loan-to-value loans are considered higher risk, which means the system may require stronger credit or income. 4. assets and reserves. DU and LP also evaluate financial reserves. Reserves are funds available after closing. These reserves show the system that the borrower can continue making payments even if income changes. One of the most misunderstood things about automated underwriting is how compensating factors work. The system doesn't evaluate each category separately. Instead, it analyzes the entire risk profile together. For example, a borrower with lower credit score may still be approved if they have a large down payment, significant savings, low debt, strong income stability. Conversely, a borrower with excellent credit may still be declined if their debt-to-income ratio is too high. This system is constantly balancing risk factors against strengths. Many people assume you need perfect credit to get approved, but automated underwriting doesn't work that way. The system evaluates the overall probability of repayment. That means a borrower with a 660 credit score, low debt, a large down payment, strong income may be approved before someone with a 780 credit score, but very high debt obligations. Mortgage approvals are about total risk, not just credit score. Once a loan receives an approved eligible findings, it doesn't mean the loan is fully approved yet. It means the system has determined the borrower meets the guidelines if the information is verified. The lender must still verify documentation such as pay stubs, W-2s or tax returns, bank statements, employment verification, an appraisal. As long as the documentation supports what was entered into the system, the loan can proceed to closing. Sometimes buyers are surprised when a loan gets denied after initially being approved. That usually happens when new information changes the risk profile. For example, new debt appears on the credit report. Income was calculated incorrectly. Bank statements reveal undisclosed liabilities. Employment changes before closing. When that happens, the loan must be resubmitted through DU or LP. If the updated information changes the approval risk, the system may no longer approve the loan. One of the biggest mistakes borrowers make during the mortgage process is changing their financial profile before closing. Examples include opening new credit cards, financing furniture or appliances, buying a car, changing jobs, moving large amounts of money between accounts. Any of these changes can impact the automated underwriting decision. That's why lenders often say, don't change anything financially until after closing. Understanding how mortgage approvals actually work gives you a huge advantage as a home buyer. Most approvals aren't decided by opinions or guesswork. They're determined by sophisticated automated underwriting systems used by Fannie Mae and Freddie Mac. Those systems analyze your credit, income, debt, assets, property details, and calculate the overall risk of the loan. The stronger your financial profile, the more likely the system is to return an approved eligible result. If you're thinking about buying a home and want to know what DU or LP would say about your loan scenario, reach out and I can run the numbers for you. And if this video helped you understand how mortgage approvals really work, make sure you subscribe for more mortgage education and home buying strategies.